Everyone on YouTube is trying to convince you that you should buy the UNH dip, that the Congress cannot stop buying this stock. Even the value investing subreddit is full of people saying that you should buy UNH, is the best stock ever. But this is so far from the truth. The Congress is buying pennies and UNH is not cheap at all. Nevertheless, I do agree on some of the takes on Novo Nordisk, on how it is a really wide moat company, and at this moment in time it looks to be at around a fair valuation. Let's take a look at both companies and we'll start with UNH. The first problem is that this P ratio is misleading. Everyone's saying that it is super cheap, it is a value buy, not at all. The management said yesterday that the earnings per share for 2025 will be around $16 per share. This means that if we divide the current share price by the earnings per share of this year, we get a real P ratio of 16. Consequently, right now, UNH is trading above their historical P ratio. It's not the 11 P ratio. Moreover, a 14 P ratio is still really expensive, because if we take a look at this stretch, we can see that UNH was never above a 10 P ratio. So using the average on that period, we can see that a bottom for UNH would be a P ratio of 8.5. This would send the stock to $135. And the misleading P ratio is not even the biggest problem. We haven't talked about debt. It would take the company around 6 years to pay off their whole debt. And when you look at the intrinsic value that we get from the DCF, you're like, oh Chris, but the company looks very undervalued. Well, yes and no. As all the other YouTube videos are showing, we're using the latest year of free cash flow, but we should be using the one that the management is expecting for 2025. When we update this one, we see that UNH is trading at around a fair value. I say it's trading at around a fair value because we're only using an 8% discount rate, and the S&P 500 usually returns a 10%. Therefore, what's the point of buying an individual stock if we would be better off buying the S&P 500? I would argue that we should discount the free cash flow rates at a 10%. When we do this, we get a fair value that is much closer to $200 per share. And I guess that everyone will argue that this is the best stock from the healthcare sector, well, the insurance sector. It is much more profitable than its peers and their margins are so much better. Well, the only reasons their margins are so much better are the reasons why UNH is also crashing, and that's because they are denying all the possible claims. So far it's been working up until people had enough. As we can see here, public frustration, which resulted in the ex-CEO being completely gone, and the revenues will keep going up because it's an essential sector. The only thing that we don't know if it will keep going up is the net income. This sector should be essential because everyone needs healthcare, so it makes sense for them to make money. The only thing that doesn't make sense is for them not to pay the claims. I mean, at the end of the day, the people have the insurance. So if people had enough, maybe their free cash flow and their net income will stop growing, which makes much more sense. And then again, it is true, right now we can get it with a 4% dividend yield, which has never been possible in history. But you should also know that right now we're paying 2 times book value in order to buy it. And 10 years ago, we could buy this business, UNH, at 1.5 times book value. If it was to be priced the same way it was 10 years ago, the fair price would be around $151 per share. So let's talk about moat. The reputation is there, but is the bad reputation. They are using AI, they are denying the claims, so they are profiting from economies of scale, but most importantly, they are profiting from government protection. If the government wasn't protecting UNH, it would be just an average insurance company. And you can see no one on YouTube is talking about, oh, Humana, it's a wide moat company, Elephants is a wide moat company. No, because look at the profit margin. It's 2%. UNH's profit margin is around 6%. If they had no government protection, look at this. Or their free cash flow would be slashed in half, and the fair price per share would be around $70. The only reason this is not the case is because they have the government protection. Low cost provider, it is not. High switching costs, yes. Network effect, also true, and you cannot change this. This will probably remain. The only thing is that regulation might affect their margins. They might not allow such high margins, which a 6% it's a low margin, but for UNH it really affects the valuation. Would it be a buy according to Warren Buffett? Of course it would. Like, look at this profitability. The ROCE is above 14%, the ROIC is also above 14%, the return on equity is super good, the net income, free cash flow, dividends, everything's growing. The dividend is safe even after we did this adjustment. Nevertheless, the valuation is still expensive. We cannot get it with a 5% owner's yield. Right now the debt seems manageable and they've been growing their gross profit at a much higher rate than inflation. Overall, my fair price per share would be around $190. You can see that my valuation has not changed. I already said in this video that I would not consider buying it if it didn't fall below $180 per share. If we want a 10% margin of safety, we would have to buy it at around $170. Not even looking at the future nor looking at the past, this company doesn't look cheap at all. Hopefully you've enjoyed this video. If you even learned something new, I'd be super happy. Hope you have a great day, and as always, I'll see you en la próxima.